The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Friday's sell-off becomes Monday's buying opportunity. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. and buy the dip has really defined the mood on this Monday trading session. The S&P 500 higher by about 0.5%. We are off our highs of the session, and we haven't exactly clawed back all of Friday's losses. But it's interesting. You take a look at what's leading the charge here. It's the biggest losers from Friday, and you can see that in the Philadelphia Semiconductor Index, higher by about 6.2%. We were lower by more than 10% on this index on Friday, but still quite a healthy gain there, even though we did have a little bit of back and forth between Iran and Israel over the weekend. Brent only higher by about 1% here, below $95 a barrel. And the 10-year Treasury yield a little bit higher as well, Romaine, trading about 2 basis points higher to 4.55%. Not exactly derailing what's going on in the equity market.
Absolutely not, with yields up, crude oil up, and that semiconductor index at 6%. Event risk really haven't broken that dip buying instinct. At least that's the thesis of Nuveen strategist Laura Cooper, a thesis playing out in today's rally. But there is a note of caution once again about whether investors are too eager to look past some of those elevated multiples. Bank of America strategists citing an increasing number of bear market signposts like cash flow conversion flatlining and CapEx spend eroding the share of share buybacks. Cameron Dawson over at New Edge Wealth sharing similar concern.
So the whole dynamic that had happened at the start of the year is that valuations derated significantly to about 17 times on the stocks just because earnings estimates went up so much. Now we've effectively reclosed that gap where we've seen valuations get back up to 28 times forward. So arguably you could say that the easy part is over, meaning the valuation reset is over. And now the question is, do you still see earnings upside?
But a lot of folks on the street, they do actually see that earnings upside. Morgan Stanley strategist led by Mike Wilson saying Friday's sell-off was a healthy reset with earnings growth and macro data still supportive. UBS saying continued AI adoption alongside a healthy consumer, that can drive earnings growth of 20% for the S&P this year. And Citi flagging 10% further price upside for the S&P amid a CapEx super cycle they say should lead to some positive earnings surprises in the quarters to come. Of course, that sentiment around the AI trade does face another big test with earnings from Oracle on Wednesday as well as the SpaceX IPO arriving after the bell on Thursday. Going to be curious to see if this week ends up being a repeat of what we saw last when traders kicked off Monday seeking more exposure to the tech trade, Katie, before scurrying off to the corner on Friday.
Well, let's add to that sort of broader earnings conversation with this chart behind me. It comes from our next guest. And it's really interesting that if you take a look at EPS, that is your orange line right here for the S&P 500. You can see that really it's just been a steady climb higher year to date. But you think about that valuation reset. Valuations, in our next guest's view, still lower, perhaps still room to run here. You can see that we've bounced back a little bit from that nadir that we saw in March, but still an opportunity, especially when you consider how strong earnings have been so far in 2026, Romaine.
Well, let's get right to him. Jonathan Golub joins us here in Studio 2, Managing Director and Chief Equity Strategist at Seaport Research Partners, kicking us off to the close. Clawing back a good chunk of the losses from Friday, a sell-off that you kind of characterize as out of sync with, I guess, what we're seeing in terms of corporate and macro fundamentals?
Sure. I mean, the earnings, and I think Katie caught it in the chart before, the earnings are absolutely on fire, and they keep getting ratcheted higher and higher. The earnings for the semiconductor group are up more than 50% since January 1st. I mean, I've never seen anything like that in my career, and you're seeing that pretty much throughout all of tech and the broad market as well. And valuations are lower almost everywhere.
Well, let's talk about valuations. I understand the argument about this phenomenal earnings growth we've seen, but we've also seen phenomenal price growth in the stocks as well. I mean, we're talking about several of these names doubled, tripled, even more than that over the span of just a few months. So why isn't that run up in share prices pushing, in your view, that multiple to a level that maybe isn't in sync with those fundamentals?
Well, I mean, Romaine, it's really simple. There's a P and there's a PE. If the earnings are going up faster than the price, the stock is getting cheaper. And if you look at some of these AI semi-names like Avago and Nvidia, they're trading at multiples that are in the bottom half of the tech universe. Yeah. And their earnings are expected to grow 50-60% or more over the next 12 months.
I appreciate you using Avago instead of Broadcom. Remember those old commercials when they were trying to get everybody to pronounce Avago, right? And when
I can't say I do.
Okay, anyway.
I still say Google though. I can't get to Alphabet, so I hear you.
What about Facebook versus Meta? There's a whole host of examples we could use there.
There was one Brady on those commercials, by the way.
Oh, that's good to know.
Sure.
I'll YouTube it later. Yeah. Let's talk about psychology, though, near-term psychology in this stock market, because I hear what you're saying when it comes to the fundamental backdrop, the earnings backdrop, et cetera. But there was a really interesting note from Bank of America dated June 5th, basically saying to take profits, short-term profits here, because there's too many red flags right now. And I wonder, you think about how far we've come, especially from the depths of March. How great do you think that temptation, that urge is for investors right now to maybe lock in some gains?
If investors are locking in gains where the fundamentals don't justify it, you have to buy it. And I mean, if you take a look, and there was two things that spooked the market last week. The one was maybe there was a blip in demand on the AI side, and this is on the back of Avago or Broadcom delivering earnings growth of more than 50% year over year, and they beat by 1.5 or 2% on the number, and people thought that wasn't enough. But if you also look at on the economic side, I mean, I'm looking at, on the Bloomberg terminal, the economic surprise. Companies have been beating economic estimates by really since, I guess, September. I mean, you're talking about 9 months where the data's coming in better. The jobs data was strong. We're seeing the ISM is strong. So basically, future demand is there. So it's really a healthy backdrop. And so I just don't see any fundamental argument to, in general, are there niches that look like they're, do I think the hyperscalers look like there's a cash flow problem? Yeah, I think so. But we're not talking about the broad market. We're talking about small groups.
Well, I want to talk a little bit about what you were saying about, the economy right now, because you point out measures such as the City Economic Surprise Index. It's been in positive territory all year. That jobs report that we got on Friday wasn't just strong, it was really a blowout print. So again, you take stock of this market. Do you think that this is an equity market that can withstand the potential of a couple of rate hikes, or at least one?
Yeah, and that was part of the story, was that the market is now, let's think about the narrative, and then let's look at the data. The narrative is, well, there's no way that the Fed is going to cut interest rates now. Well, first, why does the Fed cut rates? Is because the economy is not strong enough on its own. It needs the help. The economy is saying is we don't need the support. So that's one thing. The other is when you actually, again, go looking on the Bloomberg terminal, what is the amount of what's the change in late last week on how much people expect the Fed to do? A half a cut. A half a cut, and the market sells off like it did on Friday. That's rounding. It's just not enough.
But was the issue, though, also so much just about what the Fed is going to do with regards to the short end of the curve? It seemed that there was a little bit more consternation about that potential increase that we're seeing on the longer end of the curve, which seems to be a little bit divorced from where people think monetary policy might actually go.
Sure. I mean, but yeah. What was the move on the 10-year on Friday? 6 basis points? Yeah. I'm not saying that it's nothing. What was more important to me as an equity strategist, the high yield spreads widened out, which is bond investors getting a little bit concerned. Yeah. The VIX blew out. And if you look at what's happened today, the VIX has come back in. Yeah. And so
blew out. It went at like above 20, which is like, remember the old days when a blowout on the VIX was like when it would get up into the 40s, 50s, and 60s?
Oh yeah, I mean, this is not like if one of my favorite stats is what's the probability of a recession? Because really, that's what equity investors are concerned about. Because that's when earnings fall apart and multiples take a hit. The probability of recession right now, since the beginning of the year, is down from 30% to 25%, and the data is saying that that's probably well overstated.
All right, Jonathan, great to have you back here on the program. Jonathan Golub, Managing Director, Chief Equity Strategist over at Seaport Research Partners, kicking us off to the close here on another consequential week for AI. And our next guest says you can't have those AI data centers without power. We're going to catch up with the CEO of FuelCell Energy, fresh off the company's latest quarterly report and a big backlog that has everybody talking.
And then from power to processing power, big news out of WWDC today related to the future of Siri. We'll talk to Siri's co-founder and former CEO.
Well, can Siri tell me how exactly I'm supposed to get to MetLife Stadium next week? FIFA World Cup kicking off in multiple cities around the U.S., particularly here in New York. We're going to catch up with Lasry, the CEO of the New York, New Jersey host committee for the World Cup. All that and more coming up in a bit, right here on The Close. This is Bloomberg. Let's check in on shares of FuelCell Energy. The share is down more than 10% after the company reported earnings this morning. It missed on several key metrics on revenue and profitability. But some investors really trying to look a little bit further down the road, and that's the pipeline of potential power needs for a lot of the AI data centers being built. Pleased to say joining us right now here in Studio 2 is the CEO of FuelCell Energy, Jason Few. Jason, great to have you here.
Remain great to be here.
I do want to talk about this backlog, about a 267% bump up in that backlog. But the big question is, when does that backlog actually convert to actual sales and cash that shows up on the income statement?
Yeah, so if you look at our growth between Q1 and Q2, that's where you get that 267% increase. We now sit at about 5 gigawatts of pipeline. Converting that pipeline is really all about the data center customers getting comfortable with behind-the-meter solutions, which that is starting to increase. If you think about this, this is really a phenomenon that's just been happening over the last year and a half or so. And so we are very focused on converting that pipeline. And as we said on our earnings call today, we expect that to happen this fiscal year.
Well, I want to talk about that trend because most of the narrative around the data center build out was the idea of them being connected to the grid. And obviously we've seen backlash to that from consumers, not to mention just a lot of concerns as to whether the capacity is even there. So now it's this idea of kind of bring your own power, for lack of a better phrase, which is basically what companies like FuelCell, Bloom, and a few others are doing here. Is the narrative for investors going to start to put a little bit more attention on companies like yours relative to the traditional grid power providers?
Yeah, I think if you look at what's happening today, the big challenge for the grid is interconnection queues, right, is one part of the problem. And then two, power being where the data centers want to be. It's not just about total available power on the grid. And so being able to solve that problem, distributed generation technologies like ours really enable that from the behind the meter. And we've been doing that as a distributed power provider, delivering utility grade power for over 23 years. Now we're just taking what we do in a distributed fashion on the utility grid, mirroring that and putting it behind the meter and delivering the utility exactly to where the power is needed. And we do that in a way that also deals with some of the backlash issues. You know, we don't pollute because we don't combust the fuel, so we don't emit things like NOx and SOx and other particulates. We operate at a very low decibel level, pretty similar to an air conditioner in your home, so neighbors aren't going to complain about noise level. And because we operate with both the power and the thermal energy, we can really help data center customers bring down what they call their PUE, which you want to get as close to about 1.0 as you can on that. And by doing that, we help them get more power to compute. And that's really what they're trying to do, is get more power to compute, and we deliver a time to power solution.
Well, you're touching on a topic that we talk about in relation to the data center build out often, and that is, you know, not in my backyard, the NIMBYism. You think about all the concerns, founded or not, about, you know, what's contributing to higher energy costs. You mentioned noise levels as well. When you think about your future growth and the opportunity that you have in this space, I mean, how big of a hurdle could that sort of backlash be? How are you factoring that in?
We think that we actually are a very good answer to that community backlash, because what are the things that they've been complaining about? Power prices and their belief that power prices are being driven up by data center demand. Well, if you put behind the meter solutions, who's paying for that power is very clear. I don't think people in general want to stop progress. They just don't want to pay for other people's progress. I think also when you look at what's happening with air pollution and those kind of issues, well, we avoid those issues. And so a lot of the things that the community complains about, we actually solve with our technology, and those same complaints go away. We have a water neutral solution, so we're not utilizing water. So all of the things that you hear as complaints, our technology actually addresses those complaints for the community.
And one of the things that you said today, one of the things that came out of your earnings release was that 90% of your pipeline can be traced to data centers right now. What's the other 10%? Is the intention that data centers will be 100% of that pipeline?
No, we don't anticipate that it will be 100% of the pipeline, but our other balance of customers are more of our traditional business, which are utilities. So we still sell to utilities who put our power solution on their networks, in addition to large commercial and industrial customers that need utility scale power, but want that power to be power they control. So they have certainty in pricing, they have certainty in availability and reliability. And so those customers continue to be an important part of our pipeline.
Jason, really appreciate it.
Thank you.
Interesting company. Jason Few is the president and CEO over at FuelCell Energy. And we continue our conversation about AI and how it's touching every industry out there, including healthcare. We're going to catch up with Erin Wright, Senior Equity Research Analyst of Healthcare Services at Morgan Stanley Equity Research, as part of our top calls. And when we come back after the break, this is Bloomberg. Time now for our top calls. The big movers on the back of analyst recommendations. Let's start off with Cummins. UBS upgrading the maker of truck engines to buy on AI-fueled tailwinds that might actually benefit the company's growing power business. The price target goes from a near street low 565 to a street high 850 with current valuation. The analyst says offering a discount to some data center power comps, believe it or not. That stock, which plunged 4% on Friday, clawing back some of those losses today. Next up, Avis Budget. Barclays upgrading to equal weight. The price target goes to 160. The firm expecting favorable fundamentals to persist in Q2, shouting out the upcoming World Cup as a potential catalyst. Those shares up 4% on the day. And finally, Biogen. Needham upgrading the biotech company to buy with a 255 target. The primary driver, the pipeline, which the analyst writes has the potential to drive more than $7 billion in combined peak sales. The stock, though, down for a second straight day. And those are some of our top calls. So you do want to stay in the healthcare space and take a closer look at United Health. Shares of the healthcare giant quietly outperforming since Morgan Stanley raised its price target to $453 last week and named the stock its top pick, fueled by AI tailwinds. Joining us right now is Erin Wright, Senior Equity Research Analyst of Healthcare Services at Morgan Stanley Equity Research. Erin, all right, I mean, a lot of people don't put AI and healthcare together, but I've heard this theory before that if there's any industry that would be ripe for the productivity and efficiency improvements from AI, it would be the healthcare space. What are you seeing?
Thanks again for having me. And yes, I agree. It's I think it's ripe for disruption in terms of making healthcare more efficient. It's very manual, data heavy, a lot of restrictions around that data. And we think there's a meaningful opportunity to unlock significant efficiencies across the entire healthcare system, not just within managed care, but managed care in particular, I think has a tremendous amount of opportunity. We see a significant amount of earnings upside potential for companies like United as they lean in more to AI and some of the initiatives that they're doing there.
What does the sort of the, I guess, cost-benefit balance look like now? Because there's been a lot of talk, at least in these early goings, that this isn't necessarily cheap to implement right out of the gate.
So United Healthcare is spending $1.5 billion this year on AI. They basically went in with a new management team and said, what's the AI budget? Let's double it. And then now they're seeing almost about $1 billion in cost saves in year one.
Okay.
It's significant. And so we're going to see, that scale over time, and it's something that's going to be meaningful from an earnings perspective. We think across our entire healthcare coverage universe on the managed care side, we could see about 45% earnings upside just from saving on admin cost alone. There's about $80 billion in admin cost spend across the healthcare system today. What if you could automate about a quarter of that, which is what we think. And so we think that that could be meaningful and offer meaningful kind of upside potential that we think is also underappreciated, not embedded in street expectations at this point.
Yeah, I mean, to that point, when we think about the conversation around AI and healthcare, it typically extends to, more of the biotech, the pharma side of things, where, the conversation is more centered around drug discovery and the like. When it comes to the managed care space, it sounds like you're saying that this could be sort of a sector-wide sort of lift here. But what is UNH in particular doing that has them standing out to you?
I would say it's two things. One, obviously they're a step ahead of others in terms of how much they're spending on AI initially, and the initiatives that they have from an admin cost perspective, whether it's around automating authorizations and other call center type of admin fees, that kind of stuff. But I also think what's underappreciated here is that they're an enabler of AI. That across their Optum Insight business, they're actually creating their own platforms that are there to help support providers, to help support patients, to help make the whole system more transparent, easier, and more efficient. And that's going to drive not only cost saves across the entire healthcare system, but also other revenue streams, higher margin revenue streams for United Healthcare.
And what kind of timeline are we talking about here? I mean, is this a story that you expect to play out over quarters, or are we talking years here?
Definitely years. I don't think healthcare moves at the pace of Silicon Valley. It's something that it takes time, and you're dealing with people's livelihoods, and inherently that does take time. But there is some initial blocking and tackling, again, that we're already starting to see with companies like United.
So when do we think we're going to hear a little bit more from the companies themselves on the conference calls and these earnings reports about, and really articulate the longer term? I know we've heard from a couple of companies, but even if you go through this last earnings season, there are quite a few. Even seeing some of the comments, or the questions, I should say, by some of the analysts on the call about AI and the, this is my characterization, the somewhat inability for management to actually articulate a strategy.
It's hard because a lot of it's pretty abstract. It's not exactly straightforward, and the healthcare system is complex. But I think what we're trying to say, especially in our work, is that there are some tangible data points already. Saving 75% on an automated claim. That's significant. And you're dealing with obviously numerous claims across the entire healthcare system. And so I think there are some proof points. And it's not just AI, it's also some of the utilization trends that we're seeing that we're more positive on. And I think that there's a two-pronged kind of thesis here in terms of our approach to United, as well as the reason why we were more positive across the entire managed care group more recently.
All right, Erin, it's a fascinating conversation, one I expect that we're going to be having more in the future. That is Erin Wright. She is Senior Equity Research Analyst of Healthcare Services over at Morgan Stanley Equity Research. An interesting look at the healthcare space. I will just quickly point out that healthcare as a sector still lower on the year, Romaine, down by about 1.7%, even though you do have all this enthusiasm around potential M&A, consolidation, and the like. Yeah,
and it was kind of interesting, too, when we saw the sell-off last week, how many people gravitated to that, obviously as more of a defensive posture here. And, of course, that's being unwound just a little bit, but it kind of makes you wonder whether there's something a little bit more substantive and less cyclical.
Absolutely. Well, we're going to pivot coming up ahead and talk about Apple's AI ambitions.
More AI.
It's a key watch list item for this week's Worldwide Developers Conference. We'll catch up with Dag Kittlaus. He is the Siri co-founder and former CEO.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. Keeping an eye on shares of Apple actually slipping today after the tech giant's annual Worldwide Developer Conference keynote. Now, the biggest takeaways include the next generation of its AI platform, which includes an update to its Siri digital assistant. So let's get a breakdown now from Bloomberg Tech co-host Ed Ludlow. He joins us live from Cupertino right now. So, Ed, as I mentioned, a bit of a lukewarm response here to that keynote that we heard earlier. Talk us through the main highlights and what's not exactly going over that well.
Yeah, it's a big reboot of Apple's artificial intelligence offering. It's a reboot of Siri, and also like how the underlying operator systems work across its devices. But when it comes to the features, like a lot of this is coming into the real world, what Apple promised some time ago. So the headline is that Siri has a standalone app. It has a chatbot style interface, and it works in an interoperable fashion across all the devices. You can go from using Siri AI on iPhone to Mac OS onto your iPad in one single project. It goes from a place where Siri has just been a single command feature space to doing tasks that are multi-step in exactly the same way that ChatGPT or Google's Gemini or Claude already exist out in the real world. Maybe with the stock's reaction, right, we went from a place where the moment Siri AI gets confirmed and announced, the stock hits a session high 2.7%. It's now down 1.5%, and that's where we're heading. You can say, well, that's sell the news, because a lot of these details are out there. But there wasn't one extra big thing. There isn't anything from a sort of capability standpoint that is outside of what Apple has promised historically. You know, Google's Gemini model will be a part of the technology in conjunction with Apple's own models that power all of this. It goes into base beta for developers today. It will go to wider release in the US at the end of this year, but EU not until next March. China, there's no timeline because of the regulatory hurdles. What is convincing and what Bloomberg is writing about is that whether these are new ideas or that what they demoed demonstrates something new, the main point and main takeaway is that they seem to work and that they seem to be genuinely useful, which puts Apple back in the game, right? If your starting position was that they were behind. But with this drop, Apple's still the second best performing stock in the Mag 7 so far this year.
All right, fair context there, Ed. Really appreciate your reporting. That is Bloomberg Tech co-host Ed Ludlow joining us live from Cupertino. And let's keep the conversation going with our next guest, who, of course, was instrumental to the creation of Siri, which is one of Apple's early advancements in artificial intelligence. Joining us live, I'm thrilled to say, is former Siri CEO and co-founder Dag Kittlaus. Dag, great to have you with us. So I'd love to hear first off your reaction to what you heard today, because we spoke to you back at the end of January. You said that, perhaps there's been some missteps along the way when it comes to execution in making Siri a bigger part of your life. You fast forward to where we are in early June. Do you think that this update goes far enough?
Yeah, I think it's a great first step in sort of the Siri renaissance. So there's a lot there. It's hard for people to comprehend on such a quick presentation everything that this use of context brings, visual intelligence, and the fact that it's very likely going to work very well. And that's a difficult thing to convince people of with such a short thing. But I think once they start using it, I think you'll see the power of what Apple brings and what context brings.
Well, talk to us a little bit about that, what you heard today that you're most optimistic about. And, you mentioned the power that Apple brings in the tool that they have in Siri, the potential avenues there. I mean, what do you think that Apple brings that can help differentiate Siri for what I'm sure are going to be a lot of competitors coming on the scene?
Well, the thing that they focused on, which I totally agree with, that consumers are going to care about, is the privacy, the security of knowing that you have an assistant that can know everything about you and is in a very secure, starting space. And then once you have that data, that context allows you to do a lot of things that are uniquely Apple. So, the fact that it knows about your relationships, it's got, real-time health data. So Siri can turn into your, health advisor, your fitness instructor. There's a lot of use cases in there that haven't fully been grokked by the wider sort of population here that are going to matter a lot.
I am curious, though, Doug, about just kind of the overall utility of this. And they really seem to want to highlight this idea that this isn't kind of the plaything or the toy, that this is sort of, the true assistant in your pocket, if you will. But there are a lot of us already using either third-party apps or even using, Claude or something like that itself to do a lot of the things that they showed off today. So I do wonder just about the competitive landscape that they're sort of trying to push this into relative to what was basically no competitive landscape, more or less, 10 years or so ago when this thing came out.
So I think you'll have a lot of people trying to compare the two, but I think once you start using it, you'll recognize the difference pretty quickly. GPT or Claude doesn't know what the intensity of your workout was, how well you slept last night, the relationships that you have across, different avenues of your life. Once you combine all of those things, that unlocks a lot of things that I think aren't, naturally obvious to, on first blush. So, yes, you can always open up ChatGPT the way you always have been, but I think Siri's going to take a large percentage of the share of how people use it today as consumers.
With regards to the actual usage and more importantly, the idea of what the potential cost can be, they talked a lot about, first, of course, obviously relying on private cloud servers or private cloud compute, I think was the language that they used. But they also said, look, there'll probably be some sort of a data cap, if you will, which I assume you can probably buy out of. But it gets to this idea of the utility relative to the cost. Do you think they're going to find a way to, I guess, strike that balance for the consumer?
Yeah, I think 80 to 90% of every query that you're going to use as a consumer you'll be able to run on an on-device model, which means you have essentially a data center in your pocket with free tokens. So, yeah, I think that's going to be pretty disruptive to any frontier company who wants to charge for large data centers when essentially you've got 1 billion data centers running around in people's pockets.
Are the current chips and more importantly also the battery that we have in these devices, are they going to be capable of handling that additional load?
Yeah, I just read an article about how they've almost gotten to the point with the existing chips that are shipping now where they can run the entire thing locally. So that's literally zero token cost, and things only get better from here.
And Dag, I want to go back to what you were saying about, some of these frontier models. When you think about a world where, maybe there's more interconnectivity between all these apps, you don't have so many individual islands that, you could imagine a world where this sort of threatens that frontier consumer business model. Talk to us a little bit more about that and, over what potential timeline you could see that playing out, because certainly that's a different world than the one that we're currently living in when it comes to consumer AI.
Yeah, so I believe that is Apple's secret weapon here, is that today apps are islands, right? They're islands of functionality. You open each one, but they don't work together. And Apple has an opportunity to use the power of the largest app store in the world and the entire economy that creates to actually build bridges between those apps, allow people to do much more complex and much more useful queries that combine applications. And I think I sent you an example of that. I can give you a few if you'd like, but I think using the power of the App Store is sort of the next chapter that can propel Apple forward and really give them an advantage over others.
So, just real quickly, we only have about a minute left, but when we talk about some of the examples here, sort of give me an idea of a way just a normal person, meaning like a techie person, would get the most value out of this.
Well, out of the ones released today or the future I'm describing?
The future you're describing.
So, for example, planning a night out, you have to use about 4 different apps specifically to do that. Call an Uber, find a restaurant, check the traffic to see how long you need to leave before the appointment. I think you can ask that in one query in the future. All of these things work together and make it far more simple to get things done. And I think that's always been the goal of Siri. And actually, we called it back in the day a do engine instead of a search engine for that very reason.
All right. Doug, really appreciate it. Doug Kittlaus there. He is, of course, the co-founder of Siri. He also co-founded Viv, which was later sold to Samsung there. A closer look at our AI-assisted future. Now, we're going to make a hard pivot from that to the world of food. You might not have heard of our next company, but you've certainly tasted it. They basically make a lot of the ingredients, if you will, the food additives such as starches and sweeteners and other things that go into your food. The company's called Ingredion, and it just agreed to buy a company called Tate and Lyle, one of the oldest listed companies on the London Stock Exchange, for about 2.7 billion pounds. That's roughly just a bit under $4 billion US. I'm pleased to say joining us right now is the CEO of Ingredion, James Zallie. James, great to have you here. First, talk about this deal here, the premium that you paid, and how, if at all, this helps you diversify your business.
Thanks, Romain, and thanks for having me on the show. Today was really a milestone day in the history of Ingredion and Tate & Lyle both. We're two storied franchises in the food ingredient space with 100-year legacies. Both companies work very closely with customers around the world to texturize foods, to fortify them, make them more nutritious, safe, as well as provide the highest quality ingredients. And today, the combination merges complementary skills, talents in the areas of formulation science, innovation on behalf of our customers, to bring new foods, new consumer-preferred innovation to the food industry, as well as complementary supply networks for more reliable supply, assurance of supply to our customers around the world. The premium that we paid is 59%, and it's a very fair premium for the quality of organization that we have acquired. And there's $130 million of synergies that this acquisition will deliver, cost synergies specifically. And it will create a $10 billion ingredients powerhouse for the food ingredient industry.
I am just still curious, though. I mean, just kind of looking at some of the commentary that you've had on recent conference calls, it seemed like you were moving your business, Ingredion, a little bit further away from just sort of the commodity-like products itself. Does Tate and Lyle add to that, or are they just adding other commodity-style products?
Ingredion has been in a transformation to a more solutions-led ingredient company, away from singular ingredients, but more towards systems and solutions, which is what customers are looking for to drive innovation, specifically for healthier products, products that would have protein fortification, offer digestive health, metabolic health benefits, as well as interesting and desirable textures to improve what we call overall liking and preference for consumers. So we've been on this journey for the last 10 years. Tate and Lyle enables us to leapfrog forward, given their capabilities in mouthfeel, sweetening, and fortification.
Right.
So together, there's tremendous synergies to advance the strategy that we've been on for the last 10 years.
Well, you take a look at how Tate & Lyle's shares behaved today. They did rise quite significantly, but actually just to the offer price. And the reason given for why, according to the sell side, was that there's concerns about antitrust risks here, that it's not necessarily a done deal, that this will get that sort of approval. And I wonder, how you're thinking through some of those concerns.
Yeah, we've worked very hard with Tate & Lyle on a joint agreement that has the approval of both sets of shareholders, and work through what we believe are the complements to drive innovation on behalf of customers, as well as, again, the complementary nature of the geographic footprint across the Americas, Europe and the Middle East, as well as Asia Pacific. So we feel confident that the complementary nature of the ingredient portfolios, the manufacturing and supply networks, and what that's going to bring on behalf of customers to enable more innovation, as well as supply assurance and reliability, will enable us to work with the regulatory authorities to have them understand and get approval that's going to be necessary for this transaction.
And James, less than a minute here, but you think about the deal today. You also announced a JV in India in recent weeks, another acquisition. Where are you when it comes to your M&A appetite? Should we be on the lookout for more deals from Ingredion?
No, thank you for pointing that out. I mean, we look at India as a great step forward into the most populous country in the world that is underserved by these kind of products that I talked about, ingredient solutions for health and wellness and texture. But this is a big move for Ingredion. It is the largest acquisition in our history that we will have made. And so for right now, we're focused on executing and closing on this transaction. And if we were to pursue any other bolt-on M&A, it would be smaller in nature going forward. But certainly the focus right now is Tate & Lyle, and we couldn't be more excited about combining with this storied franchise in the UK, one of the original FTSE 30 companies.
All right, James, really appreciate your time on what I'm sure is a busy day. That is the CEO of Ingredion, James Zallie. I'm going to take you to the closing bells. Up next as the S&P 500 tries to hold on to the green.
The earnings are absolutely on fire, and they keep getting ratcheted higher and higher. The earnings for the semiconductor group are up more than 50% since January 1st. I mean, I've never seen anything like that in my career, and you're seeing that pretty much throughout all of tech and the broad market as well.
Jonathan Golub over at Seaport, kicking us off to the close just about 50 minutes ago. A bit of a rally on our hands, trying to claw back some of the losses, the massive losses that we saw from last week.
Yeah, not close to, taking back all of those losses that we saw on Friday. You can see we're well off of session highs for the S&P 500, higher by 1.1% at one point today, now going to finish the day about 0.3% higher. But again, you look at the composition of the bounce back that we're seeing. It's some of the most beaten down names that are leading the charge back. The stocks, for example, higher by more than 5%. I mean, it was stunning to see that 10% decline on Friday, Romaine.
Yeah, and we should point out that decline wasn't just necessarily about valuation specifically in the tech space. There was a lot of macro concerns as well. Some concerns about an increase in inflation, an increase in oil prices, and of course a renewed spike that we saw in Treasury yields. Those yields higher once again here on this Monday afternoon. The backdrop heading into a CPI report this Wednesday and a Fed meeting about a week and a half away. Maria Vassalou joins us here in Studio 2. She's the head of the Pictet Research Institute. Great to have you here. I do want to start off with the macro because one thing that kind of got lost in a lot of the talk last week about the AI sell-off is that there were clearly some macro concerns that were driving those valuation concerns. We saw the spike in oil. We saw the spike in Treasury rates. Is there a sense here that what we saw last week might not have been just a one-off?
Certainly, we're going through a period of high uncertainty. A lot of this uncertainty is driven not only by the macro drop-off, but primarily by geopolitical concerns, and also this move from globalization to more of a reindustrialization phase, where the various economies, and particularly the U.S., is moving from pure efficiency seeking, which was the case under globalization, to a world of economic resilience. And that's costly. That requires a lot of build-up. That's going to be inflationary in the short term. At the same time, we have wars in various parts of the world, oil prices spiking, inflation rising because of that. So clearly, there are a lot of macro concerns.
With regards to the situation in the Middle East, though, I mean, it's been more than 3 months now since the Strait of Hormuz has been closed. And there are some people that would point to economic conditions and say, shouldn't they have been a lot worse? Isn't this maybe a sign that what we're seeing, and I'm speaking more from a U.S. lens, and I know things are a little bit different in Asia and Europe, but from the U.S. side, you still have an economy that's doing well. You still have inflation rising, but still relatively contained. And there doesn't seem to be any, at least in the short term, any immediate hit to corporate profitability.
I think this is exactly a point that gets missed by a lot of commentators. The U.S. economy has really shown a great resilience, and it has been producing a 2% growth over the long run, despite all these things that are going on. Now, obviously, given the build-up that is required in order to compete going forward, both on the AI front, on strengthening economic structure and resilience, on gaining more independence in strategic sectors, having all these inflationary concerns is not a good mix. So certainly, it's very justifiable to have these concerns. But I would say that I'm generally optimistic about the macro outlook for the country.
Well, when it comes to the U.S. economy, I do want to talk about, whether you think it's going to become more bifurcated, because you mentioned inflationary concerns that disproportionately hits the lower income tiers of the economy. Then you think about what we're talking about with AI. It's been fantastic for the stock market. We've seen it really make an impact when it comes to the GDP figures as well. But with that build out also comes the existential fear that that's going to replace a lot of jobs. And I just wonder, how you sort of view those things coming together and what that means, for how this economy is experienced.
Well, if we look at the history of technological revolutions, every time we had the general purpose technology that proliferated, we had very serious social changes and a big impact in the economy. In the past, the states were not particularly interfering, but would let the process clear up. As we go forward, and all these technologies are actually upscaling the human skills that are needed to remain in the workforce, there is a higher need for social policy to be coordinated with the technological progress. And I think this is particularly important in the case of AI, because as you pointed out, it will have very important social consequences. So at the same time, it comes at a time when the demographics are deteriorating, so you can actually mitigate some of these demographic issues. But there has to be a policy coordination. So we cannot let AI to just progress at uncontrollable pace to the extent that it creates significant social issues. And that, I think, is something very important to focus on going forward.
And some of those, those longer-term societal impacts that we're talking about, I mean, is this something, are these theses that are investable right now, or are these just sort of narratives that you're going to have to let play out and see how they actually take shape?
It depends on the economy and the sector. So clearly we have the US and China being leaders in these sectors, and you have other parts of the world that are lagging behind. And there are two things to consider. One is the development of these technologies, and the other thing is the applications of these technologies. And if you like, the biggest impact will be on the applications, whether these are done by followers or existing leaders in this technologies. So what is important for investors is to, depending on the sector and the economy, to decide at which part of the process they want to be. Do they want to invest in the infrastructure of these technologies, on the technologies themselves, or on the applications? But effectively, you need to have three factors in place. You need to consider the sectors that would benefit from these technologies, whether those sectors are really also affected by demographics, and whether the framework is in place for these technologies to really improve productivity.
All right, Maria, great stuff. Great to have you here. Maria Vassalou, head of the Pictet Research Institute. A closer look here at the bells as we get closer to those closing bells. The S&P holding on to some modest gains on the day, up about 0.3%. A more meaningful move higher in some of those techs and semiconductor stocks. A full breakdown of all of today's market coverage starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Katie Greifeld, taking you through to that closing bell with the global simulcast. Carol Masser and Tim Stenovic join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube here on, I guess we'll call it a bit of a rebound Monday, coming off of that significant sell-off that we saw on Friday.
Yeah, absolutely, although off our best levels of the session. Having said that, you look at something like semiconductors, they are back in a big way. I'm going to get into some of the individual gainers a little bit later, but that index overall was up as much as 7.5% today. Right now, Tim, a gain of about 5.5%.
I thought going into today we might see a little bit of a sell-off, given that we do see energy prices still elevated, though we are off our highs of the session. Still, up about 0.8% on WTI, Katie. Brent up about 1.2%. Both of these above $91 a barrel still.
I do think it's interesting, though, that dip buying impulse that was really strong at the start of the session has faded to the degree that it has, because you think about what's going on overseas with some of the high flyers in the names such as SK Hynix. I mean, we're talking about, a multi-day slump in EM, and it's going to be interesting to see if some of the concerns we were hashing over on Friday start to reassert themselves in the tape here.
Yeah, it was kind of interesting, too, to hear Jensen Huang, who, of course, was on that trip in Korea, basically talking about this was kind of a buying opportunity, citing the recent sell-off. You had a lot of Wall Street strategists, including over at UBS, Citi, and a few others, also saying, look, long-term here, the themes that led to that massive 9 to 10-week rally are still intact, even though maybe the pullback that we got last week was certainly healthy. We do get the closing bells here in New York on this Monday afternoon. The Dow Jones Industrial Average looks like it's going to sit this one out, down roughly about 75 to 80 points, or down about 0.1% or so. The S&P 500 is off the highs of the day, but it is going to hold in the green right around 7,400, up 22 points or 0.3%. The NASDAQ Composite up 0.9%. The NASDAQ 100 up about 1.6%. And we should just point out, just real quickly, the Philadelphia Semiconductor Index closing out the day higher by 6%, and the Russell 2000 up by 0.8%.
Yeah, all 30 names in that SOX higher in today's session. Back to the S&P 500, guys. Most names in the S&P 500 lower today, about 321 losing ground on this Monday. Katie, 181 to the upside, 1 unchanged.
Yeah, similar makeup when you take a look at the sector level as well. We have the circle there. You can see that tech was your big winner on the day. That's that bright green slice, higher by about 1.5% as a sector. Energy, too, having a pretty good day, higher by 1.1%. Consumer discretionary squeaking out gains, but only three sectors in the green. You had 8 in the red. Leading losses today, utilities down about 1.9%, followed by real estate down by 1.6%, Carol.
All right, so let's get to some of the individual gainers. And I'm going to start with the semiconductor names because they were such a standout. As we mentioned, the SOX higher by 5.6%. All 30 names in the index higher in today's session. Intel was the top gainer in the SOX, also in the S&P 500 and the NASDAQ 100. So you had Intel up more than 11%. Shares rising the most in a month after the information reported that Alphabet's Google will rely on Intel for more than 3 million specialized AI chips in 2028. Google deciding to tap Intel to make some of its tensor processing units, TPUs, for those in the know, after months of testing the chip maker's technology. Again, this is coming from the information citing 2 unnamed sources. The media outlet reported that Intel is receiving orders from firms like Google as the Taiwanese chipmaker Taiwan Semiconductor struggles to keep up with demand for its manufacturing capacity. Keep in mind, man, Intel has been such an outperformer in 2026. That stock is up about 200% year to date. All right, flip it on over to something, maybe a sign of the times, perhaps. We're talking about Sport Radar Group. This stock rallying and jumping the most in about 14 months. Heavy volume as well. That stock, as you can see, up nearly 10% in today's session. The sports technology company announced a multi-year global agreement with Kalshi to provide sports data and solutions for the prediction market platform that they put out in a statement. Sports Radar will supply official data from MLB, NHL, MLS, and UFC. The agreement allows Sport Radar to contract directly with Kalshi's brokers and market makers. Services include live odds, fan engagement tools, and integrity monitoring. As I said, it's kind of a sign of the times. That company, it's about a $4.7 billion market cap. It's down about 36% year to date, 5% of
What'd you put on the game
short.
tonight, Carol?
But I'm going to go for the Knicks. All in.
How much?
There you go.
All in.
Okay, she's all in.
Yeah, I'm not going to.
All right.
Not going to hedge at all.
So we might not see you tomorrow, is what you're saying.
Ooh, ouch. Okay, I'm gonna think. Come on, Knicks, they've got to do it. It's been a long time coming. Hey, and let's go on over to clean energy stocks. They were definitely on the move today, including nano-nuclear energy. I couldn't really find a clear catalyst on the Bloomberg. It's a $1.4 billion market cap company. It was up, though, about 9.7%, up almost 13% at its highs today. Benzinga Newswire noting that the stock is continuing to benefit from the EPA administrator Lee Zeldin's recent commentary supporting small modular reactor development as a national energy priority. Keep in mind, a little caveat, insiders have been aggressive sellers, with the company's chairman offloading 700,000 shares at roughly $26.68 last week. Tim and I, by the way, will be talking with the company's CEO, James Walker, in just a few minutes. All right, that's it.
All right, let's get to some of the decliners. I want to start with the big one today. A little bit of a food theme for you guys. I want to start with Apple, down 1.9%. On the day today. Shares were up as much as 3.3% earlier in the session. They fell as much as 2%. This is a tepid reaction to the next generation of AI from Apple, or this generation, I guess you could say. It's key to the company's bid to catch up with Silicon Valley peers. We had a great chat with Anurag Rana from our Bloomberg Intelligence team earlier, who reminded us that only iPhone 15 Pros and above work with the new platform, and that Apple's taking such a different approach, relying on Google. And it's not spending the capex that these other companies are spending. So we'll have to wait and see. Maybe this was a buy the rumor, as when Mark Gurman reported this stuff months ago, and sell the news event. But even in the wake of today's WWDC, the Worldwide Developers Conference, shares fell 1.9%. Also sticking with the theme, the Campbell's Company shares fell today on the day, down 0.9%. It reversed a gain pre-market. The company said during its conference call that it expects an additional 2% to 3% of inflation for next year, should oil remain around $100 a barrel. BNP Paribas says there's little in today's commentary that could actually excite investors. Campbell's shares fell by 0.9%. And let's talk a little bit about Tyson Food. This got on our radar because we were talking about the screwworm cases, not just last week, but 3 new additional cases that Bloomberg News wrote about today. Tyson Food shares fell by close to 3% today after the U.S. Department of Agriculture confirmed an additional 3 cases of New World screwworm. That brings the total number of detections in the U.S. to 5. It adds to worries for a U.S. beef industry struggling with supply tightness. And could also continue to pressure beef processing plants that have already been operating at losses due to this cattle shortage. Once again, Tyson Foods down 3% today.
I was hungry and then I was not.
Sorry, that's just the way it works.
Yeah.
All right, a quick check on yields here. Basically, modest moves across the board, but more importantly, it is the long-term trajectory here. The idea that at least on the short term, in 5 of the past 6 sessions, we have seen short-term yields rise. Your long-term yields, 30-year yield up about 5 basis points, back over 5%.
All right, guys, we're all in on sports today, and we caught up with a story that kind of, I don't know, it was kind of interesting about what's going to come up with the World Cup. The final on July 19th. Apparently, New York City is going to host a
I'm sorry, the what?
The World Cup?
The World Cup?
Yes.
Read the room. Carol Master. I know you're technically not a New Yorker. You're like a Hobokener or something like that.
She's in Jersey City.
But,
wow.
It's all the same, right?
No, it's actually
you do realize energy right now in this city has nothing to do with the World Cup. No offense to all you World Cup people.
It's not just the Knicks, guys. Everybody's excited.
I was setting you up for a goal, actually, so that you could do the big story.
Okay.
All right.
All right, should we talk about the Knicks? Let's talk about the
Yeah, let's
Knicks.
talk about the Knicks because I've been looking at the webcam down there here. It's already getting crazy.
goodness.
They're setting up this whole perimeter out there. I don't know if you know this. But one story that I thought was interesting, you know, Jalen Brunson, who is basically the star of this team and has kind of become really the face of the playoffs all season long, he doesn't really have a signature shoe. He's been wearing Kobe, various Kobe sneakers in the various games here, a Nike shoe, and there's been a lot of talk as to whether Nike might try to rush a signature shoe for Brunson, given how much success he has had.
Yeah, the idea is that, I think there was one quote in this article that if Nike were able to get this off the ground within 60 days of a Knicks championship, maybe they should win first, that it would just sell like hotcakes here. And you have to imagine there's some truth to that.
You going tonight?
No, I'm going to try
See
very
if I can
hard
get
to
through the
avoid the
perimeter
traffic.
there.
Oh, you better leave now, Romaine.
I'm just going to hang out. Isn't there a watch party out there?
No, not tonight.
No.
No, they canceled the watch party.
Just for the World Cup so far.
Have they told New Yorkers?
Mayor Mamdani will be there. The president will be there. The president, a guest of James Dolan tonight.
Of course, yeah.
We'll see.
As James Dolan does. So who else is going to be there? Who do you think is going to be courtside, Tim?
Ben Stiller will be
Timothy
there.
Chalamet.
Yeah.
Wow.
I'm interested to see if Kylie Jenner shows up. That's.
Is Spike Lee allowed back into MSG?
Will Wade thinks Spike Lee will be there.
Okay, because
he just threw that one over to me.
Okay, all right. I mean, he's been a long-suffering Knicks fan.
I hear I can watch it on Peacock
Give
tonight,
him
by the
something.
way.
Does
All
Carol
right.
have any thoughts on this, or she's just sitting? She just wanted to talk about soccer.
Knicks
All
in
right,
4, I guess is what they say.
that is a wrap. Our cross-platform coverage. We call it the closing bell. Katie and Romaine, of course, continuing there on the close on TV. Tim and I continuing on Bloomberg Business Week Daily on Bloomberg Radio. We'll see you again, same time, same place tomorrow.
When we come back, we're going to take a deeper dive into some of the market moves that we've seen, particularly in the aftermath of what was the most bruising session since Liberation Day week. A conversation up ahead about maybe where to look for your money. Jim Masturzo going to be joining us when we come back right here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. I don't know if you remember where you were on June 5th. That was just 3 days ago, Katie Greifeld, but we had a massive sell-off in U.S. equities. A lot of concerns about some of the valuations out there. Remember, the Philadelphia Semiconductor Index had plunged 10%, the worst one-day loss for that index, going all the way back to 2020. Clawing back a big chunk of those losses today, a 6% jump, as everyone now, for some reason, piling back into the pool. Intel, one of the biggest gainers there that Katie will get to. That helped to lift the S&P 500 up about 0.3%, despite the fact that we saw a continued rise in yields and a continued elevation in oil prices.
And Bitcoin also seeing a little bit of a bump up today. But let's get to some of the individual equity movers. As Romain mentioned, I put some of the biggest gainers on the board behind me. Micron and Intel was those chip makers really leading the rebound. Then you had Apple. This was your biggest weight on a points contribution basis, of course, unveiling some new initiatives when it comes to Siri. You can see that kind of went over like a wet balloon. Apple shares down about 1.9%. But let's get back to the green on the screen, because that's our top story this hour. Wall Street staging a comeback. Chip makers in particular climbing after their biggest rout since 2020, really fueling bets that this bull market still has room to run. But not everyone is buying the AI trade. You see an index of developing nation tech companies sinking into a correction, while Samsung, SK Hynix, and TSMC all drag emerging market stocks a little bit lower, Romain.
And that raises a lot of questions here about where the structural trade is right now. Jim Masturzo joins us. He's Chief Investment Officer over at Research Affiliates, and he's been taking a closer look at this. And Jim, I do want to start off first with the EM trade. And I want to kind of separate it a little bit, because we know a lot of the outperformance that we've seen in some of the aggregate indexes has primarily been because of the AI trade, and pretty much just like 4 or 5 Taiwanese, and Korean stocks that have led it. But when you look at what had been an embrace of EM relative to the developed markets, is there something there that tells you that there is a longer-term structural shift in where money might flow?
Nice to be with you. So we have long been proponents of EM stocks and their ability to outperform. And this really started, in 2025. But also this year, we see the index up about 25% year to date, so far outpacing what we see here in the S&P. And as you mentioned, East Asia is getting all of the press. Taiwan and Korea, and as you note, a few companies in Taiwan and Korea are maximizing those headlines. But as we look at the index broadly, I think investors are missing out on what's happening in Brazil. Brazil is matching the S&P, and that's after a pretty meaningful pullback in both financials and energy. Mexico, Poland, both up double digits, again, ahead of the S&P. And this is in a year when, China lags. So EM doing well when China lags is encouraging for us. Indonesia, India, meaningful laggards, definitely. Obviously, one due to concentration, the other is valuation.
Yeah.
But, we're very bullish on EM.
Well, I am curious, though, as to sort of what makes that continue, because we've sort of been in these cycles before where EM kind of becomes a hot trade, and then all of a sudden you get, some political unrest or some sort of market event over there that kind of reminds everybody why some of these names are, emerging markets and not developed markets here. So what gives you the confidence here that whatever's changing right now is going to be long-lasting?
Sure. So, you make an important point. These are emerging markets for a reason. They are inherently risky, not just at the company level, but also at the country level. But if we look at the basket, and again, for us, it's really about looking at the basket, not just East Asia, not just Eastern Europe, but the entire basket. So if the AI trade continues, you're going to maximize and benefit from continued outperformance in Korea and Taiwan. If that pulls back, if the geopolitical tensions take hold and we see a pullback in East Asia, well, that should be very good for countries like Brazil that have, strong energy, strong food, strong access to raw materials, relatively defensive position, so on and so forth. Continued escalations of war are going to be good for countries like Poland. So the basket makes us really encouraged that, yes, certain countries are going to lag and certain are going to outperform, but on average, we think this is very strong. And I should mention, this is in a year in 2025, we see outperformance when the dollar really hasn't done much.
That's where I want to go, Jim, because you take a look at the BBDXY, to your point, on the year in 2026, it's just about flat, but that's come with a lot of volatility, a lot of up and down, and certainly you've seen it strengthen a bit since the start of May when we saw the U.S.-Iran war kick off. So what influence do you see the direction of the dollar having for this EM trade, this basket trade, as 2026 continues?
So we still feel the dollar is overvalued. As you noted, the first couple of months of the year, January, February, was just a continuation of 2025. Dollar selling off relative to most other major currencies. That obviously rebounded with the war and call it the risk off trade. But as we look beyond where we are geopolitically, this overall lack of support for the war, more transactions, oil transactions in non-dollar, but most importantly, an increase in deficits. We moved into the year with high deficits. We're moving into a war that's just increasing those deficits. So that's going to push inflation higher.
And when it comes to the Iran conflict, I'm reading through your notes. You make the good point that the market continues to price a near-term resolution to the conflict with minimal long-term impacts from supply chains. You could make the same argument for sort of the dynamic that's underway in U.S. markets as well. And I wonder, from where you're sitting, how big of a risk that is to what we're talking about, especially when it comes to the supply chains, because who knows when we're going to get a resolution. But you think about the damage done already in the past few months. Would you expect that to make an appearance in the basket?
So we are cautiously optimistic, whereas I think markets at times have been, overly optimistic. I think a lot of what's happening right now is the markets are really afraid of being on the wrong side of a resolution, a la Liberation Day in April of last year. And so, every time we see, good news, we see oil sell off materially. As we see, bad news, we see just, modest rebounds. And a lot of this goes back to what I, maybe unfairly call crying wolf. If we go back to March, a lot of folks were talking about we're going to be out of oil by, April. And then in April, it was by May. And then May is by June. Well, now I actually think we are getting to a point where, the inventories are running down. Movement of oil, whether it be U.S. exports to the rest of the world, Chinese imports have been down. That can only continue for so long. So we're definitely getting to sort of this precipice where we could very meaningfully see a long-term extended tail from the supply chains. And we are, very, paying close attention to that.
Is there any sense, though, Jim, that would be sort of a widespread effect? Because, there are a lot of people that say, okay, even if this is prolonged, even if the economic ripple effects do take some time to wash ashore, the idea that at least certain countries have ballasted themselves to a certain extent from that.
It's true to some extent, but if we, let's take the U.S. We've been running down, oil out of the SPR. We've been exporting oil. At some point, in our opinion, this sort of kumbaya moment ends where everyone is kind of, viewed as everyone is helping everyone else out. Let's make sure the oil gets to everyone. And that has, fueled a little bit of the rally in East Asia. At some point, as we get closer and closer, it's going to be every country for themselves. And when that happens, we could definitely see a pretty significant shock to markets. It may not last, but we could definitely see a shock.
All right, Jim, have to leave it there. Great to get some time with you. That is Jim Masturzo. He is Chief Investment Officer over at Research Affiliates. Now, coming up, AI fears putting pressure on private equity deal making. We're going to dive into a new report out from Bain next. This is The Close on Bloomberg. Well, AI uncertainty is taking a toll on deal making. A new report out from Bain showing the value of private equity tech deals down 70% since year-end, citing fewer large deals. Allison McNeely, she is a Bloomberg private equity reporter. She joins us now to discuss. So, Allison, it seems like this is one of the byproducts of the SaaSpocalypse that we lived through over the past few months, just that existential question of, how much some of these companies are actually worth when you think about the age of AI.
That's exactly right. People are nervous and they are not willing to transact when they don't know what something is worth. Around the same time period, we also saw private equity firms marking down the value of their software investments by about 8%. And that compares to down 0.3% for the rest of the market. So people are marking things down and kind of going on pause.
It's interesting. You think about that 8%, that's a big decline. The fact that all sectors were down 0.3% is interesting as well, though. So, the fact that, like you said, people don't want to transact when there's uncertainty about what they're actually paying for, there are still deals getting done. Is that fair to say?
Yes, and it's really interesting because the folks I spoke to at Bain, they sort of pointed out there's nothing fundamentally wrong with markets? You know, we've got the SpaceX IPO in the pipeline, of course, you know, the most anticipated event, you know, potentially other IPOs this year to follow. You know, the economic data is still pretty good. The debt markets are open, and yet people are really nervous. So there are deals getting done, but it's really only kind of the best of the best that is transacting.
Well, I can see the idea, though, too, just about the lopsidedness of this all. I mean, I don't think anyone denies that there's deals out there to be had, and there is still some health in this space, but this seems to be more about that last, big vintage, which, is still bumping up against what would be the traditional exit path in terms of duration, and the idea that now you're potentially trying to exit into a world that, quite frankly, just doesn't want this stuff, or at least doesn't want it based on the valuations that were ascribed to it a few years ago.
Exactly. 2021 was really the high water mark for private equity, and a lot of deals were done at valuations that maybe just don't make sense in today's environment.
So what does make sense in today's environment then?
I think people are really focused on operational improvement, trying to figure out how to work with AI and not against AI, figuring out if it's a threat to the portfolio company, how can they incorporate it, or how can they get out, how can they add value, and really just, I think, 4 years on, people are no longer pretending that things were the way they were, and they're sort of adjusting to the new reality and realizing that they need to add value and they need to embrace AI, or else they're going to kind of have more problems.
And, I am curious, you mentioned the SpaceX IPO. You think about a lot of these PE companies, the fact that we did have this SaaS apocalypse, and now we're talking about, this 70% plunge in private equity tech deal value. I mean, how antsy are some of the big investors out there for exits at this point, and how much of a delay is it, the fact that we do have all these existential fears percolating?
I mean, I think the big private equity firms, or private equity firms in general, are extremely antsy. And that's because their institutional investors are antsy. Just before this, I was on the phone with an investor at a major US pension. And he was saying to me, it's so frustrating. I've been waiting for exits for years, and they're still not coming, and every year it's something new. So I think folks are extremely keen to exit as soon as they can for the best value that they can, but whether or not they're going to be able to do that is very much an open question.
All right, Allison McNeely, Bloomberg private equity reporter, a closer look at some of those valuations, and I guess Katie Greifeld, some of the valuations that have never actually been valued.
Yeah, absolutely, and interesting to hear about the antsiness here, really on a lot of different sides here. But let's take a look at some of the movers that we're seeing after hours. We're keeping an eye on shares of Applied Digital here, this crossing the terminal that they have signed a new lease pact at Delta Forge 2. So a new data center lease deal. You can see shares popping about 8% after hours, and Vail taking it on the chin.
Yeah, what's going on here?
Falling off a cliff.
Yeah, basically lowering its outlook here. And of course, we've talked a lot. And then we had the CEO on a few weeks ago kind of talking about this idea of some of the missteps that we saw in the most recent ski season. I mean, some of that was weather related and out of their control, but also, of course, the way that they price these passes, if people can't get there because of the weather.
Absolutely.
There you go. All right, coming up here, we actually just had a headline on SpaceX, so we're going to talk about that when we come back after the break. Getting ready for launch, Musk and crew preparing. We're going to catch up with Matt Witheiler, head of late-stage growth over at Wellington, to discuss the pros and cons of the biggest IPO ever. For years, SpaceX has transformed the business of, getting to space. Now, Elon Musk is preparing for the next challenge, convincing Wall Street to back one of the most ambitious corporate visions ever seen, and it goes well beyond space. Here's what's at stake.
Ignition.
Elon Musk wants to build the infrastructure for AI in space, and he's asking investors to help pay for it. The rocket, satellite, and now AI company wants to raise around $75 billion in what will be the largest IPO in history.
SpaceX is probably our greatest, commercial space company, hands down.
It will enable the next iteration of what we want to see as the space industry continues to grow.
This isn't just a space story anymore. After folding in Musk's AI startup xAI earlier this year, Investors buying into SpaceX are also buying into the future potential of Grok AI models and Musk's vision for massive computing infrastructure. That ambition comes with a hefty price tag. New filings show SpaceX's AI business, as in xAI, lost nearly $6 billion last year and billions at the start of this year as money poured into computing power and infrastructure to compete with OpenAI and Anthropic. Still, SpaceX has major advantages. Starlink has become a powerful cash generator through its satellite internet business, while the company's launch operations continue to secure billions in government and private contracts.
What people need to realize about this company is it isn't just a little bit ahead of the entire launch industry on planet Earth. It's orders of magnitude ahead.
And now, Wall Street wants in. Goldman Sachs, Morgan Stanley, and JP Morgan leading more than 20 banks working on the offering. And Musk negotiated record low fees. But the IPO also raises big questions like whether investors are comfortable betting not just on Musk's original vision of making humanity a multi-planetary species and getting to Mars, but on a future combining rockets, AI, and social media into one sprawling empire.
And so what we're buying is the next, the global economy, 2.0 and 3.0 as we look at buying into SpaceX.
If that happens, SpaceX could redefine what the modern public company looks like on Earth and in space.
Well, just days away from that mega IPO, let's keep the conversation going with Matt Witheiler. He is head of late-stage growth over at Wellington, joining us on a set. Matt, it's great to see you.
Thanks for having me back. Appreciate it.
So needless to say, the stakes are very high here, but let's talk about just how high, because you think about some of the consternation around this IPO, the fact that it's being fast-tracked into many of the major indexes here, and there's a lot of concerns about, the lockups, for example, not just how it performs on day one, but in the months ahead as, we get closer to those lockups expiring. I mean, again, you think about the stakes here. What does this mean, not just for SpaceX, but also for some of the other big IPOs that we're waiting on?
Well, I think it means that the world is changing from an exit perspective. If you look at what is happening, we have a company that is going to go public and be valued at north of $1.75 trillion in market cap, which has never happened before. And I think that this is a culmination of events that really started as companies started staying private longer and longer. And the fact that SpaceX has been in the private market for so long and grown revenue so much is part of what is resulting in a $1.75 trillion IPO price.
Well, we were just having that conversation with Allison McNeely, who covers PE for us, the fact that, you think about some of these PE investors, you think about institutional investors, they're feeling very antsy here. So the fact that we do have this big exit opportunity, how do you think that will sort of reshape the private investing landscape when we do have that free up of capital? How does it get recycled back into the ecosystem?
Well, first off, let's talk about what will likely happen to SpaceX, in my opinion, which I deeply believe that SpaceX will perform well in the public market. And so I think when that happens and lockup expires and some of this liquidity comes back to the institutional investors, the people funding these private firms, I think the net effect of that is that we should see continued deployment into private companies. And so I think that's healthy for the ecosystem. We've had a lack of distributions over the last 10 to 20 years. And now this is the first shoe to drop, I believe, in those distributions coming back to investors.
I am curious, though, just about just kind of how you sort of look at SpaceX as a company. And there was a great piece put out by Aswath Damodaran trying to place a more fundamental value on this. And a lot of people want to draw parallels to sort of the arc of Tesla and how it, kind of went from basically just a car company to something a little bit bigger than that, certainly in the eyes of investors. Is that what SpaceX is? Because, it's called SpaceX, but ostensibly, Elon Musk seems to be pitching this more as an AI company rather than a rocket launch satellite company.
1,000%. Yeah. And I think if you think about what is happening at SpaceX, it would be hard for me to imagine this happening if not for the fact that Elon Musk is the founder and chairperson of this company. And the reason for that is because what Elon is able to do is he's able to get investors to buy into a vision of the future that doesn't exist today, that most other entrepreneurs, most other founders, most other CEOs would not get the grace for. But Elon is different. And it was different at Tesla, where Tesla is not just a car company, to your point. You have to add in the value of the car company, plus the self-driving business, plus Optimus, their robotics business, to see why Tesla is worth what it's worth.
Yeah.
And same thing here.
Well, one reason why I was looking at that parallel, too, is Tesla, to a certain extent, had the luxury of not having a whole lot of competition, particularly when it was making EVs. So the traditional car makers basically had no interest in it, at least not at scale. And that gave him a long runway to sort of, get it right, if you will. He's coming into a crowded market when it comes to AI, for that matter. I'm talking about the AI portion of this business. He's coming into a crowded market, and even for the rocket business, in theory, Jeff Bezos might become a formidable competitor there as well. Does that change the calculus of how you look at this company, and more importantly, how you look at the potential for this to be a successfully traded public company?
I don't think it does, and I think the reason for that is because when you talk about AI and the value of SpaceX that lies in AI, for the most part, now we're not talking about Grok, we're not talking about XAI. For the most part, we're talking about orbital data centers. And who's the competition there? Nobody, because it doesn't exist today.
Right.
And so Elon is painting a vision of the future where we have, tens, if not hundreds of gigawatts of compute in our ecosystem outside of our planet that is really capturing and driving the value for SpaceX.
And Matt, before we let you go, I am curious, how this affects the rest of the pipeline, if at all, because you think about SpaceX, enormous. We know that Anthropic is targeting maybe the fall. Those are two massive IPOs coming through. And the idea exists that this will help encourage other of these pipeline companies to actually come out and hit the public markets. But you could make the case on the other end that there's going to be a crowding out effect here, that, there's just only so much investor cash that can go around.
I think that these two or three that come out this year, whether it's SpaceX, Anthropic, OpenAI, in what order, I think they will perform well, and I believe they will open up the gate for the next generation, the next level of companies to go to the public market. I worry much less around the supply of capital. When you think about how large the public ecosystem is, I think the amount of capacity to support these IPOs, where again, they're selling, in Elon's case, $70 billion, they're not selling $1.75 trillion of capital. And so I think there's plenty of capital to go fund these next generation growth stories.
All right, Matt, always great conversation. Matt Witheiler, head of late stage growth over at Wellington. A focus on the markets, but come on, guys, we got to focus on what are probably the two biggest sporting events to hit New York City in years. We're talking about the FIFA World Cup, which kicks off next week, and tonight, the first home game in an NBA Finals for the New York Knicks in more than 20 years. That conversation coming up after the break, right here on Bloomberg. All right, the FIFA World Cup kicks off on Thursday in the U.S., in Canada, and in Mexico. All three countries bracing for what is already the most expensive tournament in history. Here to discuss what to expect right here in the New York metropolitan region is Alex Lasry. He's the CEO of the New York, New Jersey Host Committee for this year's World Cup, which, of course, will be played at MetLife Stadium in New Jersey. Great to have you.
Thank you so much.
In addition to the actual matches themselves out at MetLife Stadium, there are going to be a lot of fan events right here in New York City, including at the Tennis Center in Queens.
Yeah, I mean, what we're really excited about is trying to create an experience outside the stadium that's going to rival what's happening inside the stadium. We only have 8 games, and while we have the biggest one in the final, there are going to be 104 matches over the course of the entire World Cup. So how do we make sure that fans are able to experience all that the World Cup has to offer? And that's why we're kicking it off at one of the most iconic sporting venues in the world, the U.S. Tennis Center, for our group stage headquarters.
I'm curious about, is there like friendly competition between the cities? Because we were talking last week about what Miami is doing, and obviously they have a great international football culture down there. But the idea of that for those folks who either can't get to the stadium or don't want to go to the stadium, the idea that they're going to feel to a certain extent like they're part of this as well. Have you talked to some of your counterparts in other cities?
I talk to the host city CEOs every day, and there's always friendly competition. I mean, this is sports, it's entertainment. We want as many people coming here, they want as many people coming there. Not only friendly competition between us and the host cities, but our host region has friendly friendly competition as well. So we're really excited about all that we have, whether it's in New Jersey and in New York, to bring fans and give them an authentic experience.
I want to talk about the not-so-friendly transit situation because I live in Hoboken, New Jersey. I go to the Hoboken train station every single day, and it's just plastered with warnings about how to travel around during the World Cup. And I know that, you're really relying on New Jersey Transit here. The plan is to, have 40,000 people or so ride New Jersey Transit to get to each match, which New Jersey Transit isn't reliable in the best of times. And then you think about Penn Station being a very special place as well, and service is suspended pretty frequently. So, talk us through how you're trying to ensure that, some of the infrastructure in place can actually hold up to the demand that is going to be placed on the system.
I think one of the things that we're very lucky about is that we have a pretty intricate public transit system that gets you to the stadium, unlike a lot of other host cities. And it's one where it also gives you a ton of options. So we are running a public transit mobility plan first. So New Jersey Transit is expected to run about 30 to 40,000 people to the game. We have our bus shuttle that'll be running from 3 different places in New York City, a park and ride in New Jersey. That should be moving about 18,000 people for the first game and about 16,000 on average for all the other games, getting as high as 20. We've got rideshare at the Meadowlands racetrack. So a lot of ways to get to the stadium. And look, if there are any issues with any of those modes of transportation, we've got a number of contingency plans in place. This region is used to putting on big events. This isn't the first big event that it's had to put on. And it is ready and able to deal with anything that comes in its way.
Well, let's talk a little bit about rideshare, because I was actually having this conversation with my husband yesterday. You think about some of the big games scheduled at MetLife July 5th, the day after July 4th, July 19th, also a day where I have to drive in New Jersey. And I was saying maybe the traffic won't be as bad because you won't be able to park, so maybe people won't drive. And Joe said, Katie, think about the rideshare options. People are going to be Ubering and Lyfting to the stadium. And I wonder, how you anticipate handling that, what it'll look like, what fans should expect when they actually do use that muscle memory and just go to their rideshare app.
And look, I would expect, something that's going to be busier than what it is for a normal football game, just because there isn't the same general admission parking. But I know that if you leave at a certain time to go to the Giants game from New York City, it could take you over an hour to get there, right? You're just sitting in traffic. That is part of the experience of going to a game. I think our hope and what our plan is to make sure that this is as efficient and easy and painless as possible for all the fans who are looking to get to the stadium. It's why we've got our bus shuttles that'll be getting there to the games, starting those 3-4 hours early to help on ingress so that it's not 80,000 people all trying to get to the stadium at one time, but creating a fan experience at the stadium that allows for ingress 3 to 4 hours before the game. Egress, same thing. Our fan village and everything will be open for 2 to 3 hours after the game. So trying to ease the egress as well.
Yeah.
So this is, again, not the first time that we've started to think through all of this. And we feel very confident in our mobility plan and to tackle any of the issues that might come up.
I'm just curious, too. Do you have any sense of what the potential demographics of those folks that are actually going to these matches at MetLife? Are these local folks from the tri-state region? Are these international travelers coming in to see their home country teams?
So what makes the World Cup so unique is that we're getting a great mix. I would say we are able to make sure that I think the last data I saw was a little under a quarter of the fans are local regional fans, which is great. We want New Yorkers and New Jerseyans to be able to experience this incredible event. We're then looking at another 20 to 30% that's going to be domestic, but outside New York, New Jersey, and then about 50% that's international. So getting a really great mix of travelers, but you're looking at over 70-80% of the fans will be coming in from out of this region, which is really going to spur economic impact, which is really going to lead to the over $3 billion of economic impact that we're projecting.
Well, Alex, days away from the start. Looking forward to the games actually beginning. Great to get some time with you beforehand. That is Alex Lasry. He is the CEO of the New York, New Jersey host committee for the FIFA World Cup 2026. And coming up next, our conversation with former Modell's CEO, Mitchell Modell. He's now a partner in Versa NYC. That is a sports bar directly across from Madison Square Garden. How they're bracing for Game 3 tonight. This is Bloomberg. NBA Finals tickets at Madison Square Garden hitting record resale prices, according to Bloomberg Intelligence. Now, our next guest says that the New York Knicks have become a, quote, major economic force for the city. He's a partner at Versa NYC. It is a sports bar directly across from the Garden, and also the former CEO of Modell's Sporting Goods. I'm pleased to say that joining us live in studio is Mitchell Modell himself. Fantastic to have you with us. And it's not just getting into the Garden and trying to see the game. You think about the space outside, the fact that bar space is at a premium right now. What are you seeing as we count down until the game tonight?
Well, is that before the president said he was coming or after? Listen, even after game 1 and game 2, when the Knicks won, and again, they were away in San Antonio, you would have thought they won the NBA Finals. It was unbelievable. The feeding frenzy here is unlike anything I've ever seen in sports in my entire life.
Well, to your point, the fact that the president is attending, here's a tweet from the NYPD that starting at 4 p.m. today, vehicular and pedestrian traffic closed from West 30th Street to West 35th Street between 6th and 8th Avenue. That is a massive shutdown there. And I wonder, I mean, how are you expecting that to impact foot traffic? And, you know, how do you sort of even adjust around that?
Can I tell you something? It's safety before you make money.
Mm-hmm.
We have the best police department in the world. There's no better police than the New York Police Department. Jessica Tisch is phenomenal. I trust them. And listen, we got to do what we can to protect the president. But you know what? New Yorkers are going to find a way. They'll figure out how to figure it out. We know that there's no watch parties. So come on over to Versa, come to your local bars, and let's all celebrate.
Well, somehow, Mitch, I think there'll be some impromptu watch parties if I know anything about New Yorkers. I mean, you were here. Obviously, you didn't have the bar back in the days, but I mean, the last time it was at '99, the last finals that they went to, and I know it didn't work out as well. We're talking about a city that's been starved, at least for the basketball fans that have been starved for a championship in men's basketball, just to be clear. But I am curious if you just think that what's happening in this city and the economic impact, not only from the games that might be played here, at least 2 we know today and maybe and Wednesday and maybe beyond that. But the idea that is there a longer term economic impact from people who have a renewed interest in what's going on with the New York Knicks?
Great question. Yeah. First of all, the mayor's office thinks the impact if the Knicks have 3 games will be around $465 million. But it's just not about the impact about, money from hotels, restaurants, cabs, bars, whatever. It's promoting New York. It's showcasing New York the way it should be showcased. It's bringing the city together. And it's unlike any other event. Again, 53 years. People are starving. I remember 13 years old with my brother, may he rest in peace. We were riding the Long Island Railroad with Red Holtzman when he was the coach in 1969. I was 15 years old, and we would ride the train listening to the stories, waiting all 53 years later, and we're waiting for a championship. New York is just ready to explode. No one's ever come back when they were up 2 games to when they lost the first 2 games at home. Never come back. So let's bring it home.
All right. Well, we'll see tonight what they do. Obviously, everyone's so focused right now on Jordan Clarkson, Jalen Brunson, and kind of a team that I think a lot of people looked at, even prior to last season when they had that run, and said, there's no way. This is not a championship team. There's no way you're going to beat the Thunder. There's no way you're going to beat the Spurs. There's no way you're going to get past the Cavs or any of this. We're there now here. I hate to do this. What if they lose? What if they lose the series? What does that do? Do you think that we'll still have that same energy heading into next year where people say maybe they can pull it off?
As Joe Willie Namath said, we're not losing, okay? We're not losing. All we need is to take 1 game at Jimmy's place, Jimmy Dolan's place, the Magic Garden. If we get 1 game and now we're up 3-1, they're going to have a tough time. But listen, the Knicks are playing unbelievable. I don't know what happened when they went down 2-1, but Coach Brown did something with his magic that all of a sudden the players started passing together, they're gelling together to win 2 games on the road in San Antonio, and that arena is insane. New York's ready to explode. Whoever's going to the Garden tonight, wear earplugs.
Yeah, really.
You got to get down there, though, too, or to your bar, at least. Which is
I'm going to be at our sports bar, Versa, which is on 35th and 7th.
Yeah.
We got the largest indoor-outdoor space than any bar in New York. 10,000 square feet, 33 TV sets. We're ready for the crowd. And we got these. Look at this.
These beautiful shirts.
What do we got here? All right, let's see it. Go, 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 New York.
There you go. There you have it. We can all get behind that.
That's great. That's great. Mitch, great to have you. Real treat here. Mitchell Modell, obviously, of course, who ran Modell's for years, and now has got a sports bar right across from Madison Square Garden, Versa NYC. Are you going to be down there?
I will not be. I will be trying to get home. You know, someone turned off the TV, though, when you even suggested a possibility that the Knicks could lose tonight.
Oh, yeah, I know. What can I say? Well, you found me out. You know, I'm actually a Bulls fan. Sorry, Mitch. But no, I think like most people here in New York are in New York.
But you know,
I'll still be rooting for them.
It's so great for New York.
Yeah.
It's going to bring all New Yorkers together, people that all walks of life, hugging and kissing each other. It's us against the world. Let's bring it home.
Let's bring it home.
All right, I think that's a great way to end the show with Mitch Modell, Romaine Bostick here, along with Katie Greifeld. We're going to set you up for what to watch over the next 24 hours. But if you're a New Yorker, there's really only one thing you're watching.
Big time.
And that's Knicks Spurs later tonight. Stick around here on Bloomberg, though. Before you get to Knicks Spurs, Balance the Power team will be up next with all your political coverage right here on Bloomberg.